How billionaires protect their money from inflation. Introduction: The Weekend Shopping Reality Check. I went shopping this weekend. Just regular stuff. Groceries, gas, the usual. First stop, the gas station. Used to cost me maybe $45 to fill up my tank. This weekend? $65. 20 extra bucks. Just like that. Then I hit the grocery store. Grabbed some bananas. They used to be 68 cents a pound. Now they're 89 cents. That's a 30% increase. Picked up some chicken breast. Used to be $3.99 a pound. Now it's $5.49. That's almost 40% more. Even the bread I always buy went from $2.29 to $2.89. Everything just more expensive. At the checkout, I'm looking at my receipt thinking, when did groceries become this expensive? But here's what really got me thinking. The companies that make this stuff, they're not suffering. They're not cutting back. When wheat prices go up, bread companies just raise their prices. When oil prices go up, gas companies just pass it along to you. When their costs go up, they have a simple solution: charge more. And once prices go up, never come back down. Ever notice that? Gas might drop a little here and there, but that bread that went from $2.29 to $2.89, it's staying at $2.89. Prices climb up like a rocket. They fall down like a feather. So there I am, spending 25% more on the same groceries, paying 40% more for the same tank of gas. But did my paycheck go up 25%? Did my salary increase 40%? Of course not. My costs went up. My income stayed the same, which means I'm getting poorer, and I'm supposed to just adjust, buy less, cut back, live smaller? But companies? They have a different strategy. When inflation hits, they don't just absorb the costs. They don't just accept lower profits. They adapt. They adjust their prices. They protect their margins. So here's my question. If companies can protect themselves from inflation, why can't you? Turns out you can. Billionaires have been doing it for decades. While regular people are getting squeezed by rising prices, wealthy people are actually getting richer from the same inflation. Same economic conditions. Completely different outcomes. Today I'm going to show you exactly how they do it. Because the only way to build real wealth is to stop thinking like a consumer and start thinking like an owner. Let's dive in. Chapter 1. Why Cash is Trash. Warren Buffett's Secret. Warren Buffett is worth over $100 billion. Want to guess how much cash he keeps sitting around? Almost zero. Berkshire Hathaway, his investment company, keeps less than 5% of their money in cash. The other 95%? Invested in businesses, stocks, and assets. Why do you think that is? Because Buffett learned something most people never figure out. Cash doesn't protect you from inflation. It makes you a victim of it. Let me show you what I mean. In 1980, a McDonald's Big Mac cost $1.60. Today, that same Big Mac costs about $5.50. If you had put $1.60 in a savings account in 1980, earning the average interest rate, you'd have maybe $4 today. You still couldn't buy that Big Mac. Your money grew, but not as fast as prices. You lost purchasing power. But what if you had bought McDonald's stock instead? That $1.60 would be worth about $200 today. You could buy 36 Big Macs. Same starting amount. Completely different ending. This is why Buffett calls cash trash. Not because cash is evil, but because cash sitting still gets destroyed by inflation. Think about it. Every year, the Federal Reserve targets 2% inflation. That's their goal. They want prices to go up 2% every year, which means they want your cash to lose 2% of its value every year. It's not an accident. It's the plan. What do billionaires do instead? They put their money into things that go up with inflation. Better yet, things that go up faster than inflation. Businesses that can raise their prices. Real estate that gets more valuable. Stocks in companies that get more profitable. They don't keep money. They keep assets. Warren Buffett doesn't worry about inflation because he owns pieces of companies that can just charge more when their costs go up. He owns Coca-Cola. When sugar gets more expensive, Coca-Cola raises the price of their drinks. He owns Apple. When components get more expensive, Apple raises the price of their phones. He owns railroad companies. When fuel gets more expensive, they charge more to ship freight. Buffett doesn't fight inflation. He owns businesses that pass inflation along to their customers. But here's what's interesting. Most people think you need millions of dollars to invest like Buffett. You don't. You can buy the same stocks Buffett buys. You can own pieces of the same companies. You can start with $100, with $50, with whatever you have. The amount doesn't matter. Principle does. Instead of keeping cash that loses value, you keep assets that gain value. Instead of being a victim of inflation, you become a beneficiary of it. Now, I'm not saying don't keep any cash. You need some for emergencies. 3 to 6 months of expenses in a savings account. But everything else? Everything beyond your emergency fund? Put it to work. Make it grow. Make it protect itself. Because if you're keeping significant money in cash, you're not playing it safe. You're playing it backwards. You're guaranteeing that inflation will make you poorer. And billionaires? They're guaranteeing that inflation will make them richer. Same inflation. Different strategy. Different outcome. Chapter 2. The Real Estate Empire Strategy. Let me tell you about a guy named Zell. In the 1970s, when inflation was running at 10% or more, most people were panicking. Interest rates were through the roof. The economy was a mess. But Zell was buying real estate. Lots of it. He borrowed millions of dollars at those high interest rates. People thought he was crazy. Today, Zell is worth about $5 billion. And those loans he took out in the 1970s? They feel like pocket change now. Here's what Sam understood that most people didn't. Inflation makes debt cheaper and assets more valuable. Think about it this way. If you borrow $100,000 at a fixed interest rate, you owe $100,000. But if inflation runs at 7% for 10 years, that $100,000 debt only feels like $50,000 in today's buying power. The debt got smaller in real terms, but the asset you bought with that debt got bigger. This is the real estate empire strategy. Buy assets that go up in value. Finance them with debt that goes down in value. I'll give you a simple example. Say you buy a house for $300,000. You put $60,000 down and borrow $240,000 at a fixed rate. Over the next 10 years, inflation runs at 4% per year. Nothing crazy. Just the long-term average. After 10 years, that house is probably worth about $440,000. But your debt is still $240,000. Actually less, because you've been paying it down. Your $60,000 down payment turned into $200,000 in equity. That's more than triple your money. And here's the kicker. Your monthly payment stayed the same. Your rent income, if you rented it out, went up with inflation. You bought the house with expensive dollars. You're paying the debt back with cheap dollars. And you're collecting rent in inflated dollars. This is why every billionaire owns real estate, not just their home. Investment real estate. Donald Trump built his empire this way. Borrowed money to buy Manhattan buildings in the 1970s and 1980s. Those loans that seemed huge back then, they're nothing compared to what those buildings are worth today. But you're thinking, I don't have millions of dollars to buy Manhattan buildings. You don't need millions. You can start small. Buy a duplex. Live in one side, rent out the other. The rent helps pay the mortgage. Or invest in REITs, real estate investment trusts. These are companies that own buildings and pay you dividends from the rent. You can buy REITs just like stocks. Some pay 5%, 6%, even 8% dividends. And those dividends tend to go up with inflation. Or consider real estate crowdfunding platforms. You can invest in commercial properties with as little as $500. The key is to own real estate, not just live in real estate. Because real estate does three things that protect you from inflation. First, property values tend to go up with inflation. When everything costs more to build, existing buildings become more valuable. Second, rents go up with inflation. When tenants' wages go up, they can pay more rent. When everything else costs more, rent seems reasonable. Third, your mortgage payment stays the same while everything else goes up. Your biggest expense becomes smaller over time. This is why billionaires love real estate. It's not just an investment. It's an inflation hedge. It protects their wealth while growing their wealth at the same time. And the best part? You can start today with whatever money you have. Find a property. Run the numbers. See if the rent covers the mortgage. If it does, you've got yourself an inflation-fighting machine. Because while inflation is making your groceries more expensive, it's making your real estate more valuable. Same inflation. Different outcome. Chapter 3, Gold, Oil, and Hard Assets. Ray Dalio manages about $150 billion for the world's largest hedge fund. He's one of the smartest investors alive, and he keeps 5 to 10% of his portfolio in gold. Not because he's old-fashioned, because he's smart. Here's what Ray understands. You can print money. You can't print gold. When governments need more money, they fire up the printing presses. More dollars, more euros, more yen. But there's only so much gold in the world. There's only so much oil underground. There's only so much farmland available. These are called hard assets. Real things. Physical things. Things you can touch. And when governments print more money, hard assets become more valuable, not because they're actually more useful, but because it takes more of those newly printed dollars to buy them. This is why billionaires own hard assets, not just as investments, as insurance. Insurance against governments that print too much money. Insurance against currencies that lose their value. Let me give you some examples. Oil. There's only so much of it, and every year we use more than we discover. Basic supply and demand says prices should go up over time. Plus, oil is priced in dollars. So when the dollar gets weaker, oil gets more expensive, which makes oil companies more profitable. Agricultural land. There's only so much farmable soil on Earth. But there are more people every year who need to eat. Bill Gates is now the largest private owner of farmland in America. Think that's an accident? When food prices go up, farmland becomes more valuable. When population grows, demand for food grows. Precious metals, gold, silver, platinum, these have been stores of value for thousands of years. Central banks around the world still keep gold reserves. Not for decoration, for protection. When their currencies come under pressure, gold holds its value. Even cryptocurrency, Bitcoin specifically. There will only ever be 21 million Bitcoin. No more can be created. Some billionaires are buying Bitcoin as digital gold, a store of value that governments can't manipulate. Now, you might be thinking, how do I buy oil wells and gold mines and farmland? You don't need to buy the physical assets. You can buy pieces of companies that own them. Want to own oil? Buy shares in ExxonMobil or Chevron. Want to own gold? Buy shares in gold mining companies. Or better yet, buy a gold ETF that actually holds physical gold. Want to own farmland? Buy shares in companies that own agricultural land. Want to own infrastructure? Buy utility companies that own power plants and pipelines. The key is to own things that are real, things that can't be printed or created out of thin air. Because when inflation hits and governments start printing money, these real assets hold their value. Your dollars might lose purchasing power, but your gold maintains its value. Your oil stocks might actually go up. This is diversification that actually works. Not just owning different stocks, but owning different types of assets. Some of your wealth in paper assets, some in real assets, some in digital assets. So when one type of money gets in trouble, your other types of money protect you. Billionaires don't put all their eggs in one basket. They don't even put all their eggs in one type of basket. They spread their wealth across different assets, different currencies, different countries, because they know that governments come and go, currencies rise and fall. But real assets endure. Hard assets are your hedge against an uncertain financial future, and you can start building that hedge today. Chapter 4, Smart Debt versus Stupid Debt. Elon Musk is worth about $200 billion. He also owes banks about $100 billion. Is he broke or brilliant? He's brilliant, because Musk understands the difference between smart debt and stupid debt. Stupid debt is borrowing money to buy things that go down in value. Cars, clothes, vacations, gadgets. Smart debt is borrowing money to buy things that go up in value. Real estate, businesses, investments. Musk borrows against his Tesla stock to buy more assets. He's using his wealth to create more wealth. And here's the secret weapon. Inflation makes debt cheaper over time. If you borrow $100,000 today, you owe $100,000. But if inflation runs at 5% for 10 years, that $100,000 debt only feels like $60,000 in today's purchasing power. Borrowed expensive dollars. You're paying back with cheap dollars. This is why billionaires never pay off their mortgages, even when they have the cash. Why pay off a 3% mortgage when inflation is running at 6%? They're literally getting paid to borrow money. Let me show you how this works in real life. Say you buy a rental property for $500,000. You put down $100,000 and borrow $400,000 at 4% interest. Over 30 years, you'll pay about $700,000 total for that $400,000 loan. Here's the thing. You're not paying that $700,000 with today's dollars. You're paying it with future dollars. Dollars that will be worth less because of inflation. Meanwhile, that property is probably going to be worth $1.5 million in 30 years. And you'll have collected maybe $2 million in rent over that time. So you invested $100,000. You got back $1.5 million in property value plus $2 million in rent. That's $3.5 million, minus the $700,000 you paid for the loan. You're left with $2.8 million. You turned $100,000 into $2.8 million. That's a 28-to-1 return. Most of that return came from smart use of debt. But here's what's important. This only works if you borrow money to buy assets that go up in value. If you borrow money to buy a car, you're paying interest on something that loses value every year. If you borrow money to buy a house you live in, that's neutral. Not smart debt, not stupid debt. Just necessary debt. If you borrow money to buy investments that grow faster than your interest rate, that's smart debt. The key is to make sure your assets grow faster than your debt costs. If you can borrow at 5% and invest in something that returns 8%, you're making money on borrowed money. Real estate often works this way. Stock investments can work this way. Business investments definitely work this way. But credit card debt? That's almost always stupid debt. You're paying 18% interest to buy things that don't appreciate. Car loans? Usually stupid debt. You're paying interest on something that loses value. Student loans? Depends. If the education increases your earning power more than the interest costs, it's smart debt. Billionaire rule is simple. Borrow cheap money to buy appreciating assets. Don't borrow expensive money to buy depreciating stuff. And when inflation is running hot, debt becomes your friend. As long as it's fixed-rate debt tied to appreciating assets, because you're borrowing today's expensive dollars and paying back with tomorrow's cheap dollars. That's not just smart. That's genius. And it's available to anyone who understands the game. Chapter 5. Building your inflation-proof portfolio. All right, so how do you actually do this? How do you build a portfolio that laughs at inflation instead of crying about it? Let me give you a simple framework. This isn't complicated. It doesn't require a finance degree. It just requires thinking like an owner instead of a consumer. Here's the basic allocation that billionaires use. 40% real estate. This includes your home, rental properties, and REITs. 30% stocks. But not just any stocks. Stocks in companies that can raise prices when their costs go up. 20% hard assets. Gold, oil, commodities, infrastructure. 10% cash. Just enough for emergencies and opportunities. Let's break this down. Real estate first. Start with your own home if you can. But don't stop there. Look for rental properties in your area. Run the numbers. Make sure the rent covers the mortgage payment. Can't afford rental properties yet? Start with REITs, real estate investment trusts. These are companies that own buildings and pay you dividends from the rent. You can buy them just like stocks. Look for REITs that own different types of properties. Apartments, office buildings, shopping centers, warehouses. Next, stocks. But be picky about which stocks. You want companies with pricing power. Companies that can raise their prices when inflation hits. Utilities are great for this. Everyone needs electricity and water. When costs go up, utility companies get approval to raise rates. Consumer staples work too. Coca-Cola, Procter & Gamble, Johnson & Johnson. People need soap and toothpaste, regardless of inflation. Tech companies with strong brands. Apple can raise iPhone prices because people will pay for the Apple brand. Avoid companies that can't raise prices. Airlines, retailers with lots of competition, commodity businesses. Hard assets next. Start simple. Buy a gold ETF that holds physical gold. When currencies weaken, gold often strengthens. Buy an oil ETF that tracks oil prices. When inflation hits, energy usually goes up first. Consider agricultural ETFs. Everyone needs to eat. Farmland and food companies do well during inflation. Infrastructure funds that own toll roads, pipelines, cell phone towers. These assets often have inflation adjustments built into their contracts. Keep some cash, but not too much. 3 to 6 months of expenses in a high-yield savings account. Use the rest for opportunities. When markets crash, you want cash available to buy assets on sale. Now, how do you actually implement this? Start where you are. Don't wait for perfect conditions. If you have $1,000, put $400 in a real estate ETF, $300 in dividend-paying stocks, $200 in a commodity fund, and $100 in cash. If you have $10,000, maybe buy some individual stocks and REITs instead of just ETFs. If you have $100,000, maybe start looking at actual rental properties. The amounts don't matter. Principles do. Own assets that benefit from inflation instead of suffering from it. Use debt strategically to amplify your returns. Diversify across different types of assets, not just different stocks. Here's the most important part. Start now. Don't wait for inflation to slow down. Don't wait for interest rates to change. Don't wait for perfect market conditions. The best time to protect yourself from inflation is before inflation hits. The second best time is right now, because every day you wait, inflation is eating away at your cash. Every month you delay, you're missing out on asset appreciation. Billionaires aren't smarter than you. They just think differently about money. They think like owners, not consumers. They use inflation as a tool, not as a threat. Build wealth that grows faster than prices rise. Now you can too. Strategies are simple. The tools are available. The opportunity is right in front of you. The only question is, are you going to think like a consumer or an owner? Are you going to let inflation make you poorer, or are you going to use it to make you richer? Choice is yours. But choose quickly, because inflation isn't waiting for your decision. It's happening right now, with or without you. The billionaires have made their choice. They're getting richer while everyone else gets poorer. Join them. Keep getting left behind. The strategies are in your hands. Now use them.